Gold has been hitting record highs, but there's a major question on everyone's mind. Is a crash coming in 2026? You've seen the headlines. Gold surged 64% last year. It's outpacing the stock market. But here's the twist. It can't keep climbing forever. Or can it? What does this really mean for you and your money? Stick around, because the truth about gold's future might be something you're not expecting. When you look at gold's rise, it seems like a clear trend, up, up, up. But that's the problem. Trends like this don't just keep going forever. There's always a tipping point. So what's really going on here? Sure, gold's up 64% in 2025. But when we zoom out, things start to look a lot less comfortable. Just take a look at the 30-year chart. Does it look sustainable to you? Because to most people, this rapid rise feels a lot more like a bubble about to pop. But here's the catch. Could this just be the beginning? What if the real story is something else entirely? You know, the biggest lesson about gold crashes comes from what happened in 1980. Everyone points to that as the defining moment when gold shot up and then crumbled. But here's the twist. Gold didn't fall just because it got too expensive. It fell because confidence in the dollar came back. In 1980, inflation was out of control, oil prices were spiking, and the US dollar, it was in free fall. Gold was the only thing people trusted. But when the Federal Reserve stepped in with interest rates going up to 20%, the dollar regained strength. And suddenly, gold didn't seem like the safe bet anymore. Here's the thing. Gold's value isn't about its price. It's about what people trust more than gold. And that's exactly where things could turn. Now, let's fast forward to today. You've probably heard people say gold will crash just like it did in 1980, but let's be real. Today's environment isn't the same. Back in the 80s, the Fed raised interest rates sky high up to 20%, and that crushed gold. But today, the US government is swimming in debt, over $38 trillion. Imagine what would happen if the Fed raised rates that high now. Interest on that debt would be unmanageable. Plus, with inflation still creeping across just about everything from housing to healthcare, gold isn't facing the same conditions. The dollar isn't exactly strong either. And the real kicker? Central banks are buying gold at record levels. So what does all this mean? Gold might not be facing the same threat it did in the past, but don't get too comfortable. It's still a volatile game. But here's the real question. How does this all line up with today's gold market? The evidence gets even stronger when you dig deeper. Take a look at 2011. Gold peaked at $1,120 an ounce after the financial crisis. People flocked to it as a hedge against financial collapse. But here's where it gets interesting. Inflation didn't show up like everyone thought it would. Instead, the economy went into recovery mode, the dollar got stronger, and gold started to lose its appeal. It didn't crash overnight, but it entered a slow, grinding decline. By 2015, gold had fallen 45%. And here's the kicker. It wasn't because gold became too expensive. It fell because people no longer needed it as a hedge. So what's the lesson here? Gold doesn't crash because it hits a certain price. It crashes when the need for it fades, and right now, that's a tough thing to predict. Now let's talk about the rapid-fire changes happening right now. First, central banks are buying gold at levels we've never seen before. This is massive. They're diversifying away from the US dollar, and that's creating a baseline demand for gold that we didn't have in previous cycles. But it doesn't stop there. US debt? It's over $38 trillion, and it's only growing. The idea of raising interest rates to 20% is out of the question now. Imagine the economic disaster that would cause. Then there's the persistent inflation, services, housing, healthcare. The cost of living is rising everywhere. So what happens if this continues? Well, gold might just keep playing its role as a safe haven, but there's a catch. If confidence in the US dollar doesn't return, the rules of the game could shift in ways we haven't seen before. Now let's talk about what this all means for you. If you're holding gold or thinking about it, this isn't just about numbers and charts. It's about real-world consequences. Inflation continues to chip away at your purchasing power. The dollar's value? Eroding slowly but surely. You might feel it when you go to the store or pay your rent. And if you're one of the many who've been investing in gold to protect your savings, this might feel like your best move yet. But here's where it gets real. What happens when central banks start flooding the market with gold, or if inflation finally gets under control? Gold could lose its protective power. This is the balancing act that could determine your financial future. If this feels familiar, like you've been here before, drop a comment below. Let's talk about it. Here's where things get deeper. The real question isn't just whether gold will crash. It's about the system that drives these rises and falls. Gold doesn't just react to inflation. It reacts to something bigger, the loss or restoration of trust. Think about it. When people start losing confidence in paper currencies, they turn to gold. But that's only part of the story. Today, central banks are propping up gold as a form of insurance against the failing trust in fiat currencies. But the issue isn't just about inflation or economic policy. It's about systemic risk, how fragile the entire system really is. And that's the unsettling part. When the system is as fragile as it is now, gold's role could shift dramatically. It's not just about market cycles, it's about the rules of the game themselves changing. And that's something most people don't fully understand. So what happens next? We're staring at two potential paths for gold. One, gold continues to rise, but in a volatile, unpredictable way. There will be sharp corrections, unexpected dips, maybe even a 15% drop. But it wouldn't be the massive crash we saw in 1980 or 2011. It would just be the normal swings in a long-term bull market. The second path? A lot darker. If the government keeps printing money, if inflation keeps eating away at purchasing power, and if central banks stop buying gold, then we could see a shift. But here's the catch. None of this is certain. And what's more, the next move is already in motion. Gold isn't just reacting to what's happening now, it's preparing for what's coming next. The question is, are you ready for the shift, or will you be caught off guard? Here's the bottom line. Gold doesn't fall because it hits new highs. It falls when the system proves that holding dollars or any fiat currency is a safer bet than holding gold. And right now, we're nowhere near that moment. Sure, there could be corrections, volatility, and ups and downs, but gold's role in the system has never been more critical, and the conditions for a crash aren't in place. The real lesson here is that understanding the bigger picture is key. Gold's value isn't just tied to inflation, it's tied to trust, confidence, and a financial system that's becoming increasingly fragile. So what's next? It's anyone's guess. But if you want to stay ahead of the curve, hit that follow button. We're just getting started.